Mutual funds are one of the most popular investments in Canada. According to the Investment Funds Institute of Canada, almost $2 trillion were held in mutual funds in Canada by the end of 2020. But what are they? The best way to think about a mutual fund is as a prepackaged investment strategy. There are literally thousands of mutual funds available, with a variety of different strategies to choose from, such as a Canadian equity mutual fund that invests exclusively in Canadian stocks. You could also opt for a US bond fund. This would be a fund that invests in fixed income issued by American governments or corporations. But you will also find funds like US small cap technology, for example. This fund would primarily invest in smaller technology companies based in the US. Mutual funds can get very specific in their investment strategies. Because it can take a long time to build a well-diversified portfolio on your own, mutual funds were designed to provide a more hands-off approach. Here's how they work. Many investors pool their money together into one big pot that gets invested on their behalf. This pot of money would be the mutual fund. It can be actively managed, or it can passively track an index. It could be invested in a combination of stocks and bonds and other securities. It could be aggressive in its strategy, conservative, or anything in between. The investment manager mandate for a fund is detailed in its fund fact sheet, which provides a short overview of the fund and its goals, as well as in other official documents such as its simplified prospectus, which can be quite a long document. There are many different mutual fund companies available to Canadians, and each provides their own suite of mutual funds to choose from. These companies provide mutual funds in exchange for fees. The most important fee is usually what's called the MER, which stands for Management Expense Ratio. For example, a Canadian equity mutual fund offered by mutual fund company XYZ might have an MER of 2%. If the manager of this fund was able to grow the value of the investments by 8% in 1 year, you would see a return of 6%, as the 2% MER would be deducted from the gross return. The same happens even if the fund has a negative return for the year. So if the fund's gross return was negative 2% for a year, the return on your money would be negative 4%. The MER covers a number of costs to run the fund, and provides the fund company with a reward to make a profit. If you had two funds that were identical in their mandate and investments they held, the fund with a lower MER would have a higher return for your money. This is one way that mutual fund companies compete for your business. Another one is by trying to provide investment strategies that beats the competition. Mutual funds have traditionally been sold through financial advisors, but you can buy them on BMO Investor Line. Generally, you place an order to buy or sell a dollar value of units in the fund. The order gets executed at the end of the trading day. This is different than buying a stock, where you have to calculate how many whole shares you can afford with the money you want to invest. With a mutual fund order, you just place the order for the amount you want to invest, and at the end of the trading day, the number of units of the fund you bought will be determined because you can own fractional units of a mutual fund. There's a lot more to learn about mutual funds. Make sure to watch our other videos in this series to learn about active versus passive strategies, ETFs versus mutual funds, and portfolio funds.